Okay, well, so brief exercise 23-3. Who wants to read letter A? Go ahead.
Purchase of land and building. And you said that was PI, cash payment and investing.
Good. Very good. Decrease in accounts receivable. Yes. Good, very good. Next. Yes. Wait, you got to read it. Issuance of stock, cash receipt in the financing section. Good. Letter D. Yes. Go for it.
Depreciation expense, non-cash investing and financing activity.
Depreciation expense is added back. It is non-cash, but it gets added to net income in the operating section. Under which method? Indirect. And what does this specific question say? Indirect. If this said a direct method, the answer would be just ignore it, or I don't know if that would be a choice, but that would be the answer would be something to the effect of just ignore it, right? Not applicable, right? Okay. And again, I see why you put investing, financing, non-cash, because that's that equation. I think that's that equation coming back. So, I just want to make sure that you get why you can use that, but you have to incorporate the asset, and it comes out to the same ultimate answer. Okay. Next, letter E. Yes. Cash receipt investing. Okay. So the proceeds, yes, go for it. Yes.
Sale of land at a gain. I have D and R.
Cash receipt investing. Which letter is that? RI, you have that. Deducted from net income in the operating section, which is D. You got it right. That was an excellent hard one, and you got it right. Good. What, do I hear confusion? There are two answers, right? Sale of land at a gain is the sale of the land. The proceeds from the sale of the land go into the investing section, right? But the gain is deducted from net income in the operating section. So there's two components here. Got it? Did I lose anybody? Do I need to go back over that? Huh? Because the gain is added to net income. So if you think about what goes into net income, in an indirect cash flow statement, in the operating section, you start with net income. So maybe I'll write this out. I feel like maybe visually. Okay. So let's just make up an income statement. Okay. You have sales for 1,000. You have cost of goods sold for 500. You have gross profit of 500. Then you have various other expenses. Okay, so you have operating expenses. I don't know, give me some operating expenses. Well, we have that's right here. Right, so you have your salaries, I don't know, I'm just writing out a few things. So you have, $50. You have depreciation for $50, whatever. Okay, you have, or I'll make it a different number. Okay, for 10. You have non-operating. And what kind of things would go in non-operating? Let's just do gains. Gain on sale of investment. How about that? Is that good? Rent revenue, right. There you go. So you gain on the sale of investment for 40. So what's net income here? 500 minus 50 is 450. 440, 400. Okay? So your net income is 400 on an accrual basis. We all agree this is accrual basis here. This is an accrual basis income statement. Okay? This number goes on an indirect cash flow statement. Can anyone even see where I just put that? It's so annoying. What can you see up to? Well, you can see up to depreciation. Well, below that, it's for me to start right. Okay, so non-operating says gain on sale of investment. I put 40, and then I said net income is 400. So you get the drift, right? So now here, if I'm doing an indirect method cash flow statement, what do you start with? What do I always say you start with? Net income. So net income is what here? 400. So you need to put this on, you need to reconcile this, you need to put it on the cash basis. So in that net income number are certain items that don't belong, that shouldn't be incorporated. Some of these items shouldn't be incorporated because they're accrual basis. You have to back them out, like the portion of cost of goods sold that's in payables or inventory. Salaries, if there's something payable still doesn't belong there. So these are the increases and decreases in payables. And then you have these miscellaneous items that affect net income but really don't have an effect on cash. Depreciation is one of those things. So you have here net income of 400. What did depreciation do to net income? It decreased it. Without depreciation, net income would have been 410. Okay? So by adding back depreciation expense in the operating section, by adding back depreciation expense at, what did I have it at? At 10, I'm putting net income back to where it would have been if you didn't put it in. It would be 410. So you add back things that were reduced, and you reduce things that were added to the net income, like gains. Oh, did I subtract the gain?
Yes.
So make that a loss. Just make that a loss. Thank you. I made it up like in 1 second. Okay, give me a break. Thank you for telling me. That should be a loss. That's correct. Okay. Otherwise, you would add. You got the drift? Does that make more sense now? So if you make an income statement on an accrual basis, that's the number you're starting with. You have to put that net income number on a cash basis. So some of that is incorporating the changes in these accrual type accounts and all these balance sheet accounts, and some of them are just numbers that don't belong in there on a cash basis. If you were working on a cash basis, you wouldn't record depreciation. It's that simple. You wouldn't record things like that. You would only, because there's no cash changed hands. That's an accrual basis entry to account for the expense in each year that you use up that asset, okay, to satisfy the matching principle. That's why you have depreciation. If you worked on a cash basis, you wouldn't have to worry about that. So you have to add it back since you subtracted it. Gains would have to be subtracted because they were added. Okay? Okay. Yes. No, it's okay.
You would record the 40 you would add 40 into the operating and then,
Yes. If this is a loss, that would also be added back. The loss, just like depreciation expense, would be added back. If it was a gain, then it would be subtracted.
and then what would go and be invested? 40?
No, the sale of the actual proceeds from the sale.
So,
I didn't give it to you.
okay.
So if you sold an asset for $100 at a $40 loss,
100 goes in investing?
then 100 goes in investing. Okay? Okay? Other questions? It takes a lot. Don't get discouraged if there's confusion. This is not a simple subject matter. This takes time to build up the intuition. That's why I want you to practice it. That's why I don't want to just give you the answer. I want you to look it up and practice it and write it down and try it. This cash flow statement is not a simple statement, particularly on the direct method. Okay?
You would add the 40 in investing, but you wouldn't subtract 60 instead of 100? I'm sorry, you would add the 100 in
The proceeds from the sale of an asset. Those assets are non-current assets. So the proceeds from the sale of those assets go into the investing section. The gain or loss is in the operating section.
but you wouldn't subtract
No.
again?
No. That's what keeps coming up over and over again. You do not subtract the gain. What you learned in your last class.
Not the gain, if it was a loss.
No. You don't do it again. It's the same. It would behave the same way. The gain or the loss would they would go in the opposite direction, but they would behave the same in the sense that you'd see them in the same places. So if you have a loss on something, you add, in the indirect method, you add back that loss in the operating section. You only show the proceeds from the sale in the investing section. Another way of looking at that, which is what I think is that per the equation, is that you look at what the basis is and then add any gain and subtract any loss. That would give you your total proceeds. That's all it's doing, is giving you the proceeds. Okay? Other questions? All right, let's keep going. Letter G. Who wants to do letter G? Yes. Go for it.
G is payment of dividends, cash payment, finance.
Good. Very good. Letter H.
Increase in accounts receivable would be D, reduction in net income of the operating.
Good. Very good. Letter I. Someone over here. This is the quiet section. Go for it.
Purchase available for sale investment.
Mhm.
And we add PI.
Good. Very good. All right. Yes. You want to do one? Oh, you have a question? Uh-huh. No. Available for sale. In trading is always current. Available for sale could be either, but usually you defer to it being a non-current asset unless you're told otherwise. Yes. Next. Want to do one? I. Oh, J. Yes. Go ahead.
Increasing accounts payable is added to the net income of the
Good. Very good. This is good. Let's carry this over. I should put this on the exam. Everyone will do great. Someone over here. Letter K. Someone on the other side over here. Anyone? Yes.
decreasing accounts payable, deducting from net income.
Good. Very good. Next. Letter L. Anyone? 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 Is that why no one's doing it? Go for it.
Loan for bank by signing a note, like a cash receipt and financing section.
Excellent. Go Joyce. That was good. Huh? All right, next. Very good. Why is that non-cash? Use the note. Use the note. Good catch. That was a tricky one. Letter N. Yes, Carol, go for it. Good. Very good. Next. Letter O. Go for it.
Issuance of bonds, RF.
Which? Good. P. Retirement of bonds payable.
Yeah, retirement of bond payable, it should be cash payment in investing section.
Cash payment financing. Why is that? Because it's a no, that's financing, right, because it's a long-term liability. Non-current liabilities go in the financing section. So you're starting to see if you follow those rules, everything fits, right? You're seeing where everything should be classified. So there are rules you have to follow and an intuition that you also have to get. Letter Q.
Okay, let's see if we learn. Okay. Sale of equipment at a loss. It's going to be A, you're going to add net income to operating. And then also,
Excellent. You got it. Very good. We have learned. How we doing? We getting it? Yeah. Good. We having like little clicks. That's good. Last one, purchase of treasury stock. Cash payment and financing. Good. Excellent. Excellent work. All right. So we're going to take a moment. That concludes. Well, actually, we have some ratio stuff in this chapter. Did I give you any homework on that? I didn't. You're doing it in auditing? Yeah, you are probably doing it in auditing because that's actually why it's really important because. Yeah, I mean, what I do want to make this comment. Okay, if you promise me that you're covering it in auditing, I won't spend a few minutes and go over it. Woo! All right then. Okay. Okay. We're going to go over this briefly. So, the reason that these ratios are very important. So we, as preparers, we put together financial statements, right? Now this actually, let me look. Actually, even if I go back further. So I'm actually going to go back just 2 slides for just a